Stocks touch all-time highs, and for that, you can thank a blowout jobs report. The employment numbers for June came in much stronger than expected, showing that one of the best-performing parts of the economy is still humming along after sputtering earlier this year in the spring, and the buyers came out in force today. The Dow Jones Industrial Average up 250 points to 18,146. NASDAQ climbed 79, and the S&P 500 added 32 to close just shy of a record. But the index did nip above its all-time closing high during the session today. And the rally was sparked by the creation of 287,000 new jobs in June. Big increase over the revised gains of just 11,000 in May. The unemployment rate did edge up to 4.9%. Average hourly earnings rose modestly. Hampton Pearson has more on the job market rebound and what it may mean for Wall Street, Main Street, and the Fed.
The June jobs surge showed employers recovering from 2 months of weak hiring, with the job growth on a roller coaster, adding just 11,000 new workers to payrolls in May compared to today's blockbuster of 287,000.
It's really important when you have a lower than expected month, as we had last month, not to jump to conclusions.
The leisure and hospitality sectors led the way in June, adding 59,000 new hires, with healthcare close behind, hiring 58,000 new workers. But the unemployment rate rose to 4.9%, with little growth in wages, and the 3-month average is just 147,000 per month.
The story from the economy is pretty clear. We're moving towards full employment. We're probably very close, and we are starting to see some clearer signs of stronger wage growth.
Data for that June jobs report was collected before Great Britain voted to leave the European Union last month, so economists don't have a gauge on the impact on the American job market. But they point to the 2.6% year-over-year gain in wages as a sign of an economy moving closer to full employment. Reasons enough, economists say, for the Federal Reserve to stay on the sidelines when it comes to interest rate policy.
This is a really important number for the Fed. This is the exact number the Fed wants to see, right? They want to see us recover, and this really supports the notion that Janet Yellen had last week or last month that this is an aberration.
Wall Street Fed watchers say the combination of the slowdown in job growth plus the economic uncertainty from the Brexit vote are increasing the odds of no Fed rate hike this year. For Nightly Business Report, I'm Hampton Pearson in Washington.
Now to Bob Pisani at the New York Stock Exchange.
What happened? 2 days ago, we were talking about a trading range for the S&P 500 between the old high of 2130 and the February lows of roughly 1800 or so. We came very close to those historic highs today, closing just shy of the 2130 level. Regardless, it's been a remarkable rally. All right, so what happened? The bulls are arguing that the strong June jobs report has created a Goldilocks scenario. We're back to strong job growth, but the Fed is still likely on hold for some months at the very least. The bears are insisting this rally has nothing to do with fundamentals or even with the idea that there is some dramatic improvement in the U.S. economy. They say that the rally is due to unusually heavy demand for both U.S. stocks and bonds, partly due to foreign demand and partly because investors are forced into U.S. stocks because of a lack of alternative investments and because Europe and China stocks are problematic right now. You know what's amazing? Either interpretation means stocks rally. They both can be right. And it was a broad-based rally today. 9 stocks advancing for every 1 declining, and new highs kept expanding throughout the day. So we had industrial names like General Electric and UPS suddenly on the new high list. All right, where do we go from here? We go to earnings, which start on Monday with Alcoa, and we find out how much this whole Brexit thing might impact the second half of the year. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.